I think that if the meeting were this Wednesday rather than last, they would cut, yeah?
I think so. I think it was discussed at the meeting, as Chair Powell said in the press conference. There was a large majority for holding, but with this information, I'm pretty sure they would cut.
Are any wrinkles in this particular print that make it less concerning than face value?
I think a little bit. There may have been some impact from the hurricane on job growth. The Labor Department said they didn't see anything strong, but you did have a pretty sizable increase in temporary layoffs. There was also an increase in the number of workers who were unable because of weather. So you could have had something that was maybe not massive, but nevertheless contributed. Also, I'd say the employment to population ratio held up, labor force participation up a little bit. But when you take it all together, these are, things to keep in mind, but it's still a clearly softer than expected report.
So you think he's going to go 50 in September?
No, we still think they're going to go 25 in September. We do now expect consecutive cuts in the remainder of 2024, September, November, December. So we pulled forward 125 basis point cut. I think 50 is a possibility if you get further weakness between now and the meeting and there is another employment report. The case for 50 might be maybe they should have done 25 basis points at the meeting on Wednesday. So they're already a little bit behind and they have to catch up. And the funds rate is very high relative to a lot of the incoming information, not just on the labor market, but also on inflation. We've seen a large improvement in inflation. Wage growth is down to 3.6% in this report on a year-on-year basis. Unit labor cost growth over the last 4 quarters is 0.5%. So the inflation mandate, they're very close.
Are we going to look back on this period and say, Fed made a mistake, they should have gone sooner, they could have prevented more fallout?
I mean, I think they should have gone on Wednesday, and I published a piece, a couple of weeks ago that said, why wait? So I do think it would have been better to go earlier, and I think now it does make sense to move to significantly lower rates. So I think there is a case that needs to be discussed for going more quickly than the very glacial sort of normalization that is in the dot plot. But we'll still get more information before the next meeting, so we don't have to make that decision right now.
I would draw your attention to, I know you're not here to talk about stocks per se, but some of the bank action. Wells down to the 200-day. That's going to be the first time since November. We mentioned Citi earlier, down 6%. Are you beginning to think more about delinquencies and credit quality?
I wouldn't say I'm very worried about it. There's obviously been some deterioration, and if the labor market deteriorates more, yes, that will add to it. Equity prices, that's obviously a different discussion that does feed into financial conditions. So far, the discussion has been around whether financial conditions are too loose for them to cut. That can obviously change quickly. People aren't asking that question anymore. At this point, though, I would still keep the deterioration in perspective. Financial conditions haven't tightened that much.
So are we getting ahead of ourselves? I mean, to Carl's point, and again, Apollo, for example, a leader in private credit, that stock is down 10% right now. Again, I guess on credit concerns, are we just rapidly going through things a bit too fast here, in your opinion, in terms of really worrying about how deep this downturn could be?
Yeah, I don't have enough insight at that sort of micro level. I would say that there's been some deterioration in credit quality. I would expect some continued deterioration if the labor market continues to soften, but at this point, it doesn't look dramatic to me.
We always follow your recession odds, and they have been low. Jan, do they change after a week like this with the ISM and the jobs report?
Well, we've been saying 15%. I do think that this, probably adds a little bit. I still think it's well below 50%. I'm, very far away from thinking that we're going into a recession, but at the margin, the data has been weaker, and that, of course, means there is at least a little bit of a change.
And why do you think we're far away from recession?
Because I still think this business cycle is one in which the slowdown in inflation in particular has been driven by supply side improvement. I also think the Fed could cut a lot more. I mean, they have 525 basis points of cuts. And while I don't expect a 50 basis point move at the next meeting, they could deliver a lot of easing if necessary.